In March 1980, the chairman of the Federal Reserve, a 6'7" giant named Paul Volcker, did the unthinkable. To crush an inflation rate that had spiraled to 14.8%, he hiked the federal funds rate to an eye-watering 20%. The economic bloodbath was immediate. Unemployment shot to 10.8%. The manufacturing sector literally collapsed. Farmers actually drove their tractors to Washington in protest. But Paul Volcker did not blink. He induced a brutal recession, and by doing so, he broke the back of inflation, setting the stage for a 4-decade bull market. Now, look at the right side of the board. Today, current Fed Chairman Jerome Powell is desperately trying to channel Volcker's ghost. He has hiked rates from 0 to 5.5% in just 16 months to fight a 9.1% inflation peak. He frequently promises the market a soft landing. But here is the ruthless mathematical reality Wall Street isn't telling you on daytime television. Powell cannot pull off a Volcker-style victory without crashing the entire global financial system. And the reason comes down to one terrifying variable that simply did not exist in 1980: leverage. Pure, unprecedented, sovereign-level leverage. In 1980, the U.S. national debt was around $900 billion, a fraction of the economy. Today, that debt has crossed $34 trillion. The underlying math has fundamentally mutated. So how did we build this trap? To understand the endgame, we have to look at the original sin. March 2020. To understand the trap Powell is in, we have to look at the original sin. March 2020. As the global economy completely locked down, panic hit the markets. The S&P 500 lost 34% of its value in just 33 days. A historic crash. The Federal Reserve panicked. They didn't just lower interest rates to 0, they executed infinite quantitative easing. They literally printed $3 trillion out of thin air in just 3 months. To put that in perspective, the M2 money supply, which represents the total amount of cash and checking deposits in the U.S. economy, expanded by an unprecedented 27% in a single year. It was the largest monetary expansion in human history. But here is the catch. You cannot increase the money supply by 1/3, while global supply chains are completely frozen and shut down, without triggering a massive devaluation of your purchasing power. By June 2022, CPI inflation hit 9.1%. The highest in 40 years. The Fed had to act fast, or the U.S. dollar would lose its global credibility. So, Jerome Powell executed a brutal pivot. He initiated the fastest and most aggressive rate hike cycle in modern economic history. But to truly understand why this sudden macroeconomic shift broke the banking system, we need a quick lesson in bond mechanics. There is an absolute, mathematically unavoidable law in global finance that dictates how debt instruments are priced. It's a simple seesaw. Bond prices and interest rates will always, without exception, move in opposite directions. When the Federal Reserve forces interest rates to go up, the market value of existing, older bonds must proportionately go down. Let's look at the commercial banks. During the 2020 and 2021 zero interest rate era, they were flush with cash. Because lending was slow, U.S. banks bought trillions of dollars of U.S. Treasury bonds to park their excess capital. However, these long-term government bonds were yielding a pathetic 1.5% return per year. Bank executives thought they were being incredibly prudent. U.S. sovereign debt is universally considered a risk-free asset. But here is the fatal catch. When Chairman Powell aggressively hiked the risk-free rate all the way to 5.5%, any new investor could just walk into the open market and buy a brand new Treasury bond yielding exactly 5.5%. Suddenly, nobody wanted to buy those old 1.5% bonds that were sitting quietly inside the bank vaults. To sell them, banks would have to offer a massive discount. Their holdings lost huge amounts of market value overnight. Mathematically, the U.S. commercial banking system was suddenly sitting on a terrifying $600 billion of unrealized losses. It was a systemic ticking time bomb, hidden in plain sight on their balance sheets. In March 2023, the brutal math finally caught up with reality. Let's look at the canary in the coal mine, Silicon Valley Bank. They held $209 billion in assets, largely locked in those exact, long-term, low-yielding 1.5% government bonds we just talked about. In finance, this is called a duration mismatch, funding long-term illiquid assets with short-term, highly liquid liabilities. When tech startups started burning through their cash reserves in early 2023, they began withdrawing their deposits en masse. To cover these withdrawals, SVB was forced to sell their bonds. But because interest rates were now at 5%, they had to sell those old bonds at a massive, catastrophic loss. Panic immediately ensued. But this wasn't a classic 1929 bank run where people lined up in the street. This was a modern, digital bank run, organized in real time on Twitter and group chats. A staggering $42 billion evaporated from Silicon Valley Bank in exactly 10 hours. The bank completely collapsed. And in the hyper-connected financial system, panic is highly contagious. Like a row of dominoes, Signature Bank followed just days later. Then, the contagion crossed the Atlantic Ocean, instantly wiping out Credit Suisse, a 167-year-old global titan. To stop the systemic bleeding, the Federal Reserve had to step in and invent a brand new emergency bailout facility called the BTFP. They essentially had to pause their own quantitative tightening just to save the commercial banking system from totally freezing. This brings us to the ultimate macroeconomic dilemma: the Federal Reserve's impossible equation. Jerome Powell was officially trapped between two catastrophic outcomes. If the Fed kept raising interest rates to fight inflation, the $600 billion unrealized loss bomb would detonate. More regional banks would collapse, potentially triggering a 2008-style systemic financial meltdown. But if they pivoted, cut rates, and restarted the money printers to save the banks, the inflation monster they had spent a year trying to kill would immediately wake up and destroy the middle class. So, what did the Federal Reserve do? They tried to secretly do both simultaneously. The Bank Term Funding Program, or BTFP, functioned as backdoor quantitative easing. In just 2 weeks in March 2023, the Fed's balance sheet spiked by nearly $400 billion. That single emergency intervention completely erased 6 entire months of grueling quantitative tightening. Wall Street instantly understood the underlying message. The Federal Reserve will always blink first. The market realized that true systemic risk would always be met with infinite liquidity. Consequently, the S&P 500 ignored the banking crisis entirely and embarked on a massive bull run. Simultaneously, hard assets like gold and Bitcoin shattered their all-time highs as investors sought refuge. They were front-running the inevitable reality. The currency was being structurally debased to keep the system solvent. While Wall Street was throwing a liquidity party, Main Street was fighting a completely different war. The Federal Reserve's backdoor money printing had a nasty side effect. It kept inflation stubbornly alive. The inflation monster didn't die. It mutated from goods inflation into sticky services and housing inflation. And this sticky inflation means interest rates must stay higher for longer, which exposes the next massive systemic risk. Welcome to the commercial real estate market. Following the pandemic shift to remote work, office vacancies hit record highs. But these empty ghost buildings are sitting on a terrifying $1.5 trillion wall of debt, maturing by 2025. These property developers originally borrowed money at 3%. Now they must refinance that debt at 8%. With zero rental income and doubled interest payments, many developers are simply handing the keys back to the banks. And who holds the vast majority of this toxic commercial real estate debt? Not the mega banks. Small and medium-sized regional banks hold roughly 70% of all commercial real estate loans in the United States. These regional banks are now caught in a fatal double trap. First, unrealized losses on their government bonds. And second, massive, actively defaulting loans in their commercial real estate portfolios, dragging them underwater. Chairman Powell knows this. He is watching the regional banking system walk on a tightrope over an active volcano. If he cuts rates to save real estate, inflation reaccelerates. If he holds rates high, the regional banks collapse. This is exactly why the bond market's ultimate recession indicator, the inverted yield curve, has been screaming a warning for months. Despite these massive structural cracks, mainstream media and politicians are currently celebrating a so-called soft landing. They claim the Fed has successfully defeated inflation without causing a recession. But Wall Street veterans know a chilling historical fact. Soft landings were also famously proclaimed in 2000 and again in 2007, right before the global economy completely collapsed. The reason is simple. Macroeconomic policy operates on a delay. It takes roughly 18 to 24 months for interest rate hikes to truly suffocate the real economy. As traditional commercial banks freeze their lending pipelines, desperate companies are turning to the shadow banking system. Welcome to the $1.7 trillion world of private credit. Unregulated private equity firms are stepping in to lend money at exorbitant, predatory interest rates. For the heavily indebted zombie companies of the modern era, this is a death sentence. A zombie company is a business that does not generate enough operational profit to even cover its interest payments. Unsurprisingly, U.S. corporate Chapter 11 bankruptcies have quietly surged to their highest levels since 2008. And it's not just the corporations. The American consumer, the engine of the global economy, is completely breaking down. Total U.S. credit card debt has shattered all previous records. And with average credit card interest rates hitting a brutal 22%, consumer defaults are violently accelerating. Commercial real estate, zombie corporations, and exhausted consumers. The perfect macroeconomic storm is finally converging. So, after surviving the shadow banking scare and ignoring the warning signs, Jerome Powell now faces an impossible trilemma. There are mathematically only three paths forward. Let's analyze path one. Keep interest rates high. The result? As we just saw, the commercial real estate market defaults, and the regional banking system completely collapses. But there is a much bigger, far more terrifying problem. It's called fiscal dominance. In 1980, when Paul Volcker famously raised rates to 20%, the U.S. national debt was $900 billion. Today, the United States national debt has crossed a staggering $34 trillion. Maintaining a 5% interest rate on a $34 trillion debt mountain changes the math entirely. By 2024, the annualized interest payment on U.S. sovereign debt surpassed $1 trillion. To put that into perspective, the U.S. government is now paying more just to service its debt than it spends on the entire Department of Defense and the U.S. military combined. Keeping rates high effectively bankrupts the U.S. Treasury, forcing them into a catastrophic sovereign debt crisis. So what about path two? Powell panics, pivots, and aggressively cuts rates to save the system. The result? The sticky inflation we discussed earlier comes roaring back with a terrifying vengeance. This creates a 1970s-style stagflation supercycle, structurally destroying the purchasing power of the middle class. The Federal Reserve is in checkmate, which brings us to the inevitable third, hidden path, which leaves the inevitable, hidden third path, the true macroeconomic endgame, yield curve control, or YCC. What exactly is yield curve control? It is when a central bank legally caps the maximum interest rate on government bonds. To see our future, we only need to look across the Pacific. The Bank of Japan has been executing this exact playbook. Facing their own massive sovereign debt crisis in 2016, the BOJ pegged their 10-year government bond yield to exactly 0%. But to enforce this artificial cap, the central bank must commit to buying every single bond that the free market refuses to buy. As the United States' $34 trillion debt wall matures, the Federal Reserve will eventually be forced to adopt this exact Japanese strategy. When global investors refuse to buy U.S. Treasuries at artificially suppressed low rates, Jerome Powell will have to restart the money printers, creating infinite liquidity to monetize the U.S. sovereign debt. This terrifying maneuver will successfully prevent the U.S. Treasury from defaulting, and it will miraculously save the regional banking system. But in macroeconomics, pain cannot simply be destroyed. It can only be transferred elsewhere. To save the sovereign bond market, the Federal Reserve must deliberately sacrifice the purchasing power of the U.S. dollar. Your bank account balance might look intact, but what those dollars can actually buy in the real economy will plummet. This is the ultimate financial illusion. Nominal numbers on your screen go up, while your real, inflation-adjusted wealth collapses. Between a catastrophic banking collapse and a slow, agonizing debasement of the currency, the Fed will always choose debasement. Paul Volcker had the luxury of a healthy balance sheet to execute his 1980 bloodbath. Jerome Powell does not. The idea of a painless, soft landing in a highly financialized $34 trillion debt system is a complete macroeconomic fairy tale. Fiat currency is now mathematically guaranteed to be debased simply to save the sovereign debt market. For the individual investor, the traditional 60-40 playbook is effectively dead in this environment. The only true mathematical defense is scarce, hard assets that cannot be printed by fiat. Physical gold, the ultimate historical safe haven with a 5,000-year track record. Bitcoin, the decentralized digital scarcity engineered precisely for this exact macroeconomic environment. And productive, cash-flowing real estate that holds intrinsic value regardless of the dollar's purchasing power. We are standing at a historic crossroads. Are we heading for a sudden deflationary crash first, or straight into the hyperinflationary fires of permanent yield curve control? Let me know your macroeconomic thesis in the comments below. If you want to survive the coming financial shift, hit that subscribe button, turn on the notification bell for more hardcore, analyst-level financial masterclasses, and hit the like button to feed the YouTube algorithm. This video is for informational and educational purposes only, not financial advice. All investing carries risk of loss. Do your own research and consult a licensed financial advisor before making decisions. Stay sharp, protect your wealth. See you next time.